So something really interesting happened back in early 2026. The US defense industry got hit with two completely contradictory signals from the White House, and it sent a shockwave through the whole sector. So what happened? Why is it such a big deal? And where's this massive industry actually going? Let's break it all down. So here's the thing that's got everyone scratching their heads. How can the government offer up a record-breaking budget with one hand and then, with the other, slap on a bunch of new restrictions? That's the real puzzle we're going to unpack here. Okay, the easiest way to think about this is the classic carrot and the stick. On one side, you've got the carrot, this absolutely massive proposed $1.5 trillion defense budget. But on the other side, you've got the stick, brand new rules that put limits on how these companies can spend their profits. First, let's talk about that carrot, because wow, this isn't just a little extra cash. We're talking about a proposed spending boom that could literally reshape the entire industry as we know it. Just let that sink in for a second. $1.5 trillion. That's the proposed budget for fiscal year 2027. I mean, to put that into perspective, that number just dwarfs anything we've seen before. It's a huge signal of massive government investment. But it's not just a big, flashy number. This represents a potential 50% jump in spending in a single year. An increase that big would send ripples through the entire defense industry, all the way from the biggest players down to the smallest part suppliers. But just as the industry was getting ready to cash in on that carrot, the White House introduced the stick, a whole new set of rules that completely changes how these companies are allowed to handle their money. Now, to really get what this stick is, we need a quick definition of something called capital returns. It's actually pretty simple. It's just how companies give profits back to their investors. The two big ways they do this are through share buybacks, where they buy their own stock to make the rest more valuable, and dividends, which are basically direct cash payments. And this is where the hammer came down. On January 7th, an executive order came out putting immediate restrictions on those exact things, share buybacks and dividends. The message from the government was crystal clear. We want you to use your profits differently. So, how much money are we really talking about here? Well, analysts figure this move would stop about $18 billion a year from going back to shareholders. That is a huge pile of cash that now has to go somewhere else. So if it can't go to shareholders, where does it go? Well, this executive order is basically forcing companies to reinvest that money back into the business itself. Things like building new factories, paying off debt to get financially stronger, or maybe buying up smaller companies to get their hands on new tech. And this, right here, created an instant dilemma for everyone, from investors to CEOs. Do you bet on the incredible growth that the giant budget promises? Or do you get nervous about losing those steady, reliable payouts to shareholders? Now, the market's first reaction was kind of surprising. You'd think that with these new restrictions, stocks would take a hit, right? But they didn't. In fact, major defense stocks actually did better than the rest of the market. That tells you that investors think the growth from that $1.5 trillion carrot is a much bigger deal than the pain from the stick. So to really understand why the market was so optimistic, we have to zoom out, because this isn't just a US story. These policy changes are happening inside a much, much bigger global trend. The thing is, we're in the middle of a global rearmament cycle. Just look at this forecast. Worldwide military spending is on track to blow past $3.6 trillion by 2030. So the US is making these changes in a world that's already pouring tons of money into defense. So how do we make sense of this whole carrot and stick thing? Well, the answer might just be that the stick is just accelerating a change that was coming anyway. A huge shift away from old-school hardware and toward high-tech, software-driven defense. The new center of gravity in the defense world isn't just about building more tanks or planes. It's about the tech that's inside them. We're talking about AI, we're talking about autonomous drones, and these super sophisticated digital networks that tie everything together on the battlefield. And economically, this shift to software is an absolute goldmine. Unlike building a jet, writing code has way higher profit margins. You can see it right here in the forecast. As the industry gets more techy, its profit margins are expected to just keep climbing. This is the perfect place for that blocked $18 billion to be reinvested. So what's really happening is that the basic business model is changing. An industry that used to be all about factories and assembly lines is starting to look and even be valued a lot more like a Silicon Valley tech company. And you can see this shift in how the market values these companies. The price to earnings multiple, which is just a fancy way of saying how much investors will pay for every dollar of profit, is going up. The market is paying a premium, treating them less like old, slow industrial companies and more like fast-growing tech firms. So when you put all of these pieces together, the carrot, the stick, the global spending boom, and this massive pivot to technology, you get a picture of an entire industry being completely reimagined right before our eyes.
This quote just nails it, doesn't it? It's like a perfect storm of government policy and crazy new technology, and it's forcing a 100-year-old industry to totally rethink its future.
Which leaves us with one final, really thought-provoking question. As we look to the future, is the very definition of defense changing? Are the weapons that will decide the next conflict going to be built not out of steel in factories, but out of lines of code in a lab?